Hello, everybody. Welcome to Friday. The S&P 500 was up 0.5% today. Didn't do the show today, so I'll just talk about kind of what happened this week. This was a really great week. We just had another all-time record close high today. We were up every day this week. We've hit 34 all-time record highs just this year alone. And of course, this is the best 2 weeks of the year, the beginning, the first half of July. Certainly living up to the billings so far with some really good returns. And what we're talking about mostly is the S&P 500, but the NASDAQ and the big tech stocks and the large growth stocks have been even doing better, actually. So today's big news was the jobs report. So they're expecting 190,000 new jobs, ended up with 206,000 new jobs. But the unemployment rate went up from 4% to 4.1%. And so this is important in terms of the Fed. They have a dual mandate, what they call full employment, which just means 4% unemployment or better. And of course, 2% inflation, looking at the core PCE as the measure of that. So we're down to 2.6% on core PCE. That dropped from almost 2.8 in the last report. So that's good. And now we're starting to see, the full employment story start to pick up more. The expectations grew quite a bit today that the Fed would cut rates in September because, again, they're looking at the jobs also as part of their, balancing act that they try to do here. So the market's going to really like that, of course. And, we are in a seasonal time frame where things are doing well. And, that's to be expected as far as that goes. We're seeing lots of cash flow come into the market. And looking at what's going on with inflation and the slowing down a bit of the economy. And again, we are getting back down to kind of norms here in terms of what the economy is doing. Yes, it's slowing down. Yes, it could turn into recession, but it's really not so far. We're just kind of coming down off of this sugar high, so to speak, that we had from all the money that was pushed out from the pandemic. Although there's still over $6 trillion in money markets. That's a lot of fuel to the fire that could be coming into the markets here over a period of time. So now, historically, the market starts to show some softness after the 17th of July. So we'll have to see how this works out for the last half of the summer. The end of July was a peak last year, dropped some 10% before the end of October. So I don't know that that'll happen this time. Too many good things going on with, a little bit of softness in the employment area for, the Fed to be lowering rates. And again, that's not a good thing. Unfortunately, in this environment, for what the stock market's looking at, I would like to see rates coming down. Not so much because it makes companies more profitable and those types of things. It's just if they leave rates up too long, they do, have the risk of a much bigger recession that could happen from this. Because the Fed lowers rates today, it still doesn't hit the economy for 3 to 18 months. So if they mess up, it could get away from them pretty easy. And they could be scrambling to lower rates even more to try to keep up with, unemployment that's going up or some other slowing that's happening. I'm not sure we'll have that happen. We've been sitting in between in kind of that Goldilocks zone of that, soft landing for a really long time now. And again, it's kind of rare, so nobody wants to talk about it, but it's where we've been. I guess we have to assume that's where we're going to be for a while. Just kind of watch for things. So, good time to be in the market. A great investing environment right now. And I look forward to being able to see, what's going to happen next week. Of course, start doing our normal, daily videos starting on Monday. So we'll talk to you then. Thank you very much.